Right now, something unusual is happening in the silver market. Within hours of the latest escalation in the US-Israel conflict with Iran, financial markets began to react. Oil surged, stock markets dropped, and precious metals moved violently. But silver did something even more interesting. It spiked toward $95 per ounce as investors rushed into safe haven assets following the military strikes on Iran. At the same time, global markets were already under pressure from rising energy prices and geopolitical uncertainty tied to the war. But here is where the story becomes strange. Because while the headlines are focused on missiles, oil prices, and geopolitics, the silver market is quietly flashing a signal that almost nobody is talking about. A signal that may have nothing to do with a short-term panic, and everything to do with the structure of the monetary system itself. Here's the contradiction. Paper silver markets still trade as if liquidity is abundant, yet physical demand keeps tightening. Premiums are rising, inventories are shrinking, and volatility is increasing. Those numbers don't normally move together, and when the numbers stop matching, markets don't just fluctuate, they start to fracture. So the real question is not simply whether silver goes to $100. The real question is this: is the war in the Middle East exposing a much deeper shift inside the global monetary system? Because sometimes markets react to war, but sometimes war reveals what was already breaking underneath. If you're watching this channel, you're probably not here for hype. You're here because you want to understand what the data is actually saying before the headlines catch up. And that's the entire purpose of this channel. We don't chase price predictions. We track structural signals inside the financial system. Because by the time the mainstream media tells the story, the market has usually already moved. That's especially true in commodities like silver. Most investors only start paying attention when prices explode, but the real signals appear months earlier inside the data. Inventory changes, delivery pressure, premium spreads, open interest shifts. These are the small details that reveal what is really happening behind the scenes. So if you're someone who prefers evidence over narratives, make sure you're following the channel. Not because you should trust me, but because every claim we discuss here can be verified directly in the market data. And when enough independent thinkers start looking at the same numbers, something interesting happens. The story begins to look very different from what the crowd believes. And right now, the numbers inside the silver market are starting to tell a story that very few people are paying attention to. Let's start with the raw numbers. Because before we talk about narratives, geopolitics, or monetary systems, we need to look at what the market itself is actually doing. First, the Western spot market. Silver recently traded in a volatile range between $88 and $95 per ounce, reacting sharply to the latest geopolitical developments in the Middle East. Price spikes followed news of military escalation involving the United States, Israel, and Iran. But price alone doesn't tell the whole story. What matters more is what's happening underneath the price. Now look at COMEX inventory levels. Registered silver, the metal that is actually available for delivery against futures contracts, has been hovering around roughly 80 to 90 million ounces. That number might sound large, but now compare it with open interest. Open interest in COMEX silver futures has frequently exceeded 120,000 contracts. Since each contract represents 5,000 ounces, that implies theoretical claims on more than 600 million ounces of silver. Which means the paper market is representing claims many times larger than the metal that is immediately deliverable. That structure is not new, but when market stress increases, the ratio between paper claims and physical metal starts to matter a lot more. Now look at Shanghai pricing. On the Shanghai Futures Exchange, silver has recently traded at a premium relative to Western spot prices. Sometimes only a small premium, sometimes several percent higher. But the signal itself is important, because when physical buyers in Asia are willing to pay more than the global paper benchmark, it suggests demand in the physical market may be tighter than the futures price implies. And then there are ETFs. Silver-backed ETFs have seen periodic inflows during geopolitical stress, particularly when safe haven demand rises. But ETF flows can be volatile. Large institutional allocations can shift quickly, which means ETF demand alone cannot fully explain the tightening signals emerging in the physical market. So if we summarize the situation, price volatility is rising. Physical premiums are appearing in parts of the global market. Registered inventories remain relatively limited, and open interest in paper contracts still represents multiples of the metal available for delivery. Individually, none of these signals are shocking, but when they start appearing at the same time, during a period of geopolitical escalation, markets begin to enter a very different type of environment. One where the relationship between paper liquidity and physical supply becomes extremely important. And that's exactly where the next part of the story begins. To understand what may actually be happening in the silver market right now, we need to separate two things that are often treated as if they were the same, but they are not. Paper silver and physical silver operate in two very different worlds. The paper market is dominated by futures contracts, options, and financial derivatives. This is where most price discovery happens. It's fast, it's liquid, and it's heavily influenced by institutional trading. But the physical market works differently. Physical silver involves real metal changing hands, coins, bars, industrial supply chains, and sovereign accumulation. And when stress enters the system, these two markets don't always move together. One of the clearest examples of this appears in price premiums. If the paper price of silver were perfectly reflecting global supply and demand, physical buyers around the world should be able to obtain metal very close to that benchmark. But that's not always what happens. In markets like Shanghai, buyers sometimes pay noticeably higher prices than the Western futures benchmark. Why would someone pay a premium for the same metal? Because the futures price represents financial liquidity, but physical metal represents actual availability, and those two things are not always identical, especially during periods of geopolitical stress. When conflicts escalate, like the current tensions involving the United States, Israel, and Iran, supply chains, energy markets, and global shipping routes all come under pressure. Industrial users begin securing supply earlier, investors begin moving toward physical assets, and suddenly the question changes. It's no longer just about price, it becomes about access. If the paper price says silver is available at $90, but physical buyers are willing to pay more just to obtain it, then the market is revealing something subtle, something that futures charts alone cannot show. Because sometimes the most important signal in commodities isn't the price, it's the gap between price and availability. And when that gap starts to widen, markets begin to test the limits of their own structure. To understand why the structure of the silver market can become fragile during periods of stress, we need to look at something most investors never pay attention to: delivery mechanics. Because silver futures on exchanges like COMEX are not just speculative instruments. They are also legally binding contracts that allow participants to take delivery of physical metal. But the process doesn't happen instantly. It follows a structured timeline. One of the most important moments in that timeline is called First Notice Day. First Notice Day is the point when holders of futures contracts must decide whether they intend to roll their position forward or stand for delivery. Most traders roll their contracts. They close the current month and open a later one. Why? Because the vast majority of futures participants never intend to take physical metal. They are trading price movements. But occasionally, something different happens. More participants decide to stand for delivery. When that happens, the exchange must ensure that the metal exists inside its warehouse system. And this is where an important metric appears: the coverage ratio. The coverage ratio compares the amount of open futures contracts with the amount of registered silver available for delivery. If the ratio is small, the system is comfortable. But if the ratio grows large, the structure becomes more sensitive, because more paper claims exist relative to the metal that can actually be delivered. Now add another layer: term structure. In normal conditions, commodity markets trade in contango. That means future contracts are slightly more expensive than the spot price. Storage costs, insurance, and financing all get priced into the curve. But occasionally, markets flip into backwardation. That's when the spot price becomes higher than future contracts. And when backwardation appears in precious metals, it often signals something important. It suggests that immediate access to the metal is becoming more valuable than future delivery. In other words, the market starts prioritizing availability over price. And during periods of geopolitical instability, like the current tensions surrounding the US, Israel, and Iran, commodity markets sometimes experience exactly this type of pressure. Not because the system has broken, but because participants suddenly begin asking a very simple question. If everyone wanted delivery at the same time, would the metal actually be there? To understand whether today's silver market is truly unusual, it helps to step back and look at history. Because the silver market has gone through moments like this before. Moments when price volatility suddenly accelerated. Moments when physical demand surged. And moments when the structure of the market itself came under pressure. One of the most famous examples happened in 1980. During that period, a group of wealthy investors, the Hunt brothers, aggressively accumulated silver. As demand surged and supply tightened, the price of silver exploded. It moved from roughly $6 per ounce to nearly $50 in less than 2 years. But the key lesson from 1980 was not just the price spike, it was how quickly exchanges and regulators stepped in once the system began to feel unstable. Margin requirements were raised, trading rules were adjusted, and eventually the rally collapsed. Then came another major moment in 2011. Following the global financial crisis and aggressive monetary stimulus, precious metals entered a powerful bull market. Silver surged again, this time from around $9 in 2008 to almost $49 in 2011. Once again, the rally ended after exchanges rapidly increased margin requirements multiple times in a short period. And here is the pattern that appears again and again in commodity markets. When prices rise gradually, the system tolerates it. But when structural pressure builds too quickly, the rules of the game sometimes change. This dynamic was described perfectly in the classic trading book, Reminiscences of a Stock Operator. Markets rarely move in straight lines. They move in waves of psychology, liquidity, and leverage. Which raises an interesting question about today. Because unlike 1980 or 2011, the current environment contains something new. Not just financial speculation, but geopolitical instability, supply chain fragmentation, and rising demand for physical assets across multiple regions. And that combination can sometimes create conditions that history hasn't fully seen before. To really understand what might be happening in the silver market today, we need to zoom out even further. Because silver is not just a financial asset, it is also a global industrial metal. And that means supply and demand are influenced by forces far beyond financial markets. Let's start with supply. The largest silver producer in the world is Mexico. A significant portion of global silver output comes from mines across the country. But silver production is rarely the primary objective of these mines. Most silver is actually produced as a byproduct of mining other metals like copper, zinc, and lead. Which means silver supply cannot always respond quickly to rising prices. Even if demand suddenly increases, production may not expand immediately. Now consider demand. One of the fastest growing sources of silver demand comes from China. Silver is heavily used in solar panels, electronics, and advanced manufacturing. As global energy systems shift toward renewable infrastructure, silver demand from the industrial sector continues to grow. Then there is India. India has historically been one of the world's largest buyers of physical precious metals. When economic uncertainty rises, Indian investors often increase their allocation to physical assets such as gold and silver. And that demand can absorb large amounts of global supply. Now add the geopolitical layer. The current escalation involving the United States, Israel, and Iran has already introduced instability into global energy markets. Oil prices react, shipping routes become more uncertain, insurance costs for trade increase, and whenever geopolitical risk spreads through global supply chains, investors begin reassessing their exposure to financial assets. That's when demand for hard assets tends to increase. Not necessarily because investors expect immediate shortages, but because physical commodities represent something different from financial instruments. They represent tangible supply in a world of rising uncertainty. And when global supply constraints, industrial demand, and geopolitical risk all begin moving in the same direction, commodity markets can sometimes respond very quickly, silver included. Beyond price movements and physical inventories, another layer of signals comes from the derivatives market. These are the subtle indicators that often reveal pressure building beneath the surface. One of those indicators is the silver lease rate. The lease rate represents the cost of borrowing physical silver in the market. Under normal conditions, lease rates remain relatively low, because physical metal is generally available. But when lease rates begin to rise, especially above 1%, it can indicate that physical metal is becoming harder to source. In simple terms, participants are willing to pay more just to access the metal. Another signal sometimes watched by traders is the swap rate. Swap rates reflect the cost of exchanging silver exposure across different financial markets. When swap rates turn negative, it can suggest distortions in liquidity between financial markets and physical supply chains. And then there is volatility. During periods of geopolitical escalation, like the current tensions involving the United States, Israel, and Iran, volatility in precious metals often rises sharply. Options markets begin pricing larger price swings. Traders demand higher premiums for protection, which means the market is preparing for larger potential moves. None of these indicators alone proves that a shortage exists, but together they reveal something important. They show that the system may be entering a phase of heightened stress, not visible to casual observers, but clearly visible to those watching the structure of the market. But before jumping to the conclusion that silver is entering a structural breakout, we need to consider the other side of the argument. Because markets rarely move in a straight line, And there are several scenarios where the current signals could fade. First, physical premiums could compress. Premiums often appear during periods of short-term stress, but if supply chains stabilize and geopolitical tensions ease, those premiums can disappear just as quickly as they appeared. Second, ETF flows could reverse. Silver ETFs often attract capital during periods of fear or uncertainty, but institutional investors are highly tactical. If macro conditions change, or if interest rates rise, ETF holders can reduce exposure rapidly, and large ETF outflows can create downward pressure on prices. Third, exchanges can intervene. As history has shown during previous silver rallies, exchanges have tools available to cool down overheated markets. Margin requirements can be increased. Position limits can be adjusted. Liquidity rules can change. These types of interventions have occurred multiple times in the past, and when they happen, speculative momentum can disappear very quickly. Finally, geopolitical tensions may de-escalate. If the conflict involving the United States, Israel, and Iran stabilizes or moves toward diplomacy, risk premiums across commodity markets could decline. Energy prices might fall, safe haven demand might weaken, and precious metals could retrace part of their recent moves. In other words, the signals appearing in the silver market today are not guarantees. They are indicators. Indicators that suggest rising stress inside parts of the system. But like all markets, silver remains influenced by liquidity, policy decisions, and global macro conditions. Which is why the most important question is not what the price does tomorrow, it's which signals continue to strengthen, and which ones fade. So if the silver market may be entering a period of structural stress, what should investors actually watch? Because in markets like this, the most important signals often appear before the biggest price moves. The first signal is physical premiums. Are buyers in Asia, particularly in Shanghai, continuing to pay higher prices than Western futures markets? If that premium continues to expand, it suggests physical demand remains strong relative to available supply. The second signal is COMEX registered inventory. Is the amount of deliverable silver inside the exchange warehouse system increasing or declining? If registered inventories begin to fall while open interest remains elevated, the coverage ratio inside the system becomes tighter. The third signal is term structure. Watch the spread between spot silver and future contracts. If the market begins moving toward backwardation, that may indicate immediate demand for metal is increasing relative to future supply. Another signal is open interest itself. If open interest begins to decline sharply while price rises, it may suggest short covering or structural repositioning inside the market. And finally, watch geopolitics. The current conflict involving the United States, Israel, and Iran is not just a regional issue. Energy markets, shipping routes, and global risk sentiment are all connected. If geopolitical instability persists, the demand for hard assets like silver can sometimes increase in ways that traditional financial models do not fully capture. In other words, the price alone will not tell the whole story, but the combination of these signals might. So what does all of this mean? Right now the world is watching the Middle East. Headlines focus on missiles, military movements, and oil prices reacting to the escalating tensions between the United States, Israel, and Iran. But markets often tell a deeper story than headlines, and sometimes the most important signals appear in places that few people are looking. The silver market may be one of those places. Rising volatility, persistent physical premiums, tight inventories relative to paper claims, and a global environment increasingly shaped by geopolitical uncertainty. None of these signals alone guarantees a breakout, but together, they suggest that something inside the structure of the market may be changing. And if history teaches anything, it's that structural changes often become visible in commodities before they appear in the broader financial system. This is not investment advice, and nothing in this video should be interpreted as a prediction. The only responsible approach is to verify the data, follow the signals, and think independently, because markets are complex. But the people who pay attention to the underlying structure often see the shift earlier than everyone else. And right now, silver might be signaling that the system itself is beginning to move.